And then the TSX, of course, closed at another record high today. U.S. markets helped by gains in tech after that antitrust ruling in the U.S. for Alphabet. For more on the markets, let's go to Sam Stovall, Chief Investment Strategist, CFRA Research. Thanks for joining us today.
Happy to be here, Marilla.
So bond yields retreating, gold hitting another record high. What do you expect in equities for the month of September?
Well, certainly history would tell us to fasten our safety belts because no matter which way you look at it, all Septembers since World War II, all Septembers following positive Augusts, Septembers after we have posted all-time highs of 20 or more, typically it's negative. So based on our outlook for the final quarter of this year and into 2026, I basically am telling clients they're better off buying than they are bailing.
Interesting. All right. We're going to see August job numbers, of course, later this week. What do you think the number the markets will want to see for the Fed to cut the rate this month?
Well, investors realize that they have to run a gauntlet of challenging economic reports between now and September 17th when the Fed announces their decision. So, yes, this Friday's employment report, which is expected to show a bit of an uptick as compared with last month, but certainly still only below 100,000 new jobs. Also likely to see an uptick in the unemployment rate to 4.3% from last month's 4.2 and then 4.1 going back to June. So employment picture could be a bit challenging. Plus, we have those two inflation reports, CPI and PPI, before the Fed finally meets.
Okay, we are also wanting to look at retail numbers today because we're seeing sort of different things there, Sam. Macy's is doing well, better than it has been doing for some time, but discount retailer Dollar Tree stock is moving down today. So we're getting sort of a mixed picture from people. What is your take on the U.S. consumer and where they're at?
Well, the consumer seems to be holding up relatively well. We do expect to see an improvement in retail sales when we get that number before the Fed meets, also with the expectation that we will be getting a rate cut at the September meeting. I guess not surprisingly, we are forecasting one. We also think the Fed will cut rates again in December, and that should help the consumer discretionary sector in general, retail in particular. And I like to repeat the old adage that consumers stop spending only when the banks stop lending.
Let's get to Google, of course, which is benefiting from its parent company and the antitrust ruling that came down yesterday after the markets closed. It does not have to get rid of the Chrome browser. It's all that it's very positive. Give me your outlook, if you don't mind, for Alphabet and the bigger tech companies, because some think that there might be a bit of a burst to the bubble.
Well, we don't really think that we're headed for a bursting bubble because actually in many ways depends on how you look at valuations. If you're comparing tech to its 20-year average based on forward 12-month estimates, the PE is trading at a 50% premium to that 20-year average. If you look to the 10-year average, it's trading at a 30% premium. However, a lot of the tech analysts that I speak with say, since really AI has only been driving the bus for the last 5 years, you're better off looking at a 5-year average. And in that case, basically we're dealing with a 10% premium. So yes, tech probably could digest some gains. You can go through a correction either in price or in time, but we feel that it's a minor digestion rather than something deep that investors will have to go through. Plus, if we're looking for earnings growth of near 20% expected in 2026 versus 13 for the market, that continues to make us positive over the coming 12 plus months.
Okay, so let's talk about where you are seeing some of the other money go to, because we've seen a pullback in tech, particular in the leader NVIDIA, which hasn't recovered today. So where is the money flowing into?
Well, as we saw yesterday, actually, the money flow to a safe haven environment, as Stephanie had mentioned just a little while ago, is pretty consistent with what historically happens to the sectors within the S&P 500 going back to 1990. The market itself has declined about 1% on average in that month. The best performing groups were your defensive areas like healthcare, consumer staples, utilities, and to a lesser extent, energy. So I'm encouraged by the fact that investors were willing to rotate rather than outright retreat. And so they're basically hopping from one lily pad to the next based on where they believe the opportunities to be. So in the month of September, I think we are going to see an uptick in volatility, profit taking likely to occur in some of the high flyers, but investors are going to remain committed to equities, focusing on those areas that have not done as well.
Sam, I do have to leave it there. Appreciate your time. Sam Stovall is the Chief Investment Strategist, CFRA Research.